Hey, welcome everyone to this HYPE webinar. And for those of you joining us for the first time, the History and Political Economy of Business and Finance cluster is a research cluster based at the Open University Business School, which brings together scholars who aim at developing a critical approach to business and financial theory. So basically, HYPE puts forward an interdisciplinary research agenda using insight from both the perspective of political economy and history. Um, so we are very pleased today to host Dr. Orsola Costantini, which I had the pleasure of meeting in different events during the old days in Pavia. So it's a pleasure to meet her again after so many years. Unfortunately, just online. So Orsola Costantini is Economic Affairs Officer at the United Nations Conference on Trade and Development, UNCTAD, and she's working in the division of globalization and development strategies. Previously, she worked as a senior economist at the Institute for New Economic Thinking in New York, and she is an alumna of the Ghislieri College, and she graduated from the University of Pavia in Italy, and in 2013 received a PhD in economics from the same institution. She has written several articles in several journals, including History of Political Economy and Journal of Economic Issues, and she is associate editor of the International Journal of Political Economy and a member of the editorial boards of Economia and Lavoro. And in 2014, her work on the cyclically adjusted budget estimate was awarded the prize by the Italian Association for the History of Political Economy. So today, Orsola will talk about finance, trade, and development, defining sovereign debt sustainability in an interdependent world. So thanks again, Orsola, for joining us today. The floor is yours. We will have a presentation and then some space at the end for Q&A. Thanks a lot again.
Thank you very much, Daniele. I'm very pleased to. I was very pleased to receive this invitation. Let me share my presentation right away so we can start. Okay, so I was asked to talk about some of the financial issues that we addressed in our yearly report, the Trade and Development Report of UNCTAD, of our division. And in addition to work into the discussion, some of the preliminary work that I am conducting on debt sustainability. Yes, I have to, clarify the disclaimer that the opinions expressed are mine only when, especially, I will talk about my preliminary work. But let me start with some of the material that we presented in this year TDR in 2022. Of course, when we talked about some specific financial issues and risks during the past year, some of the issues seem, quite far away right now, and it's very difficult to after 6 months after the publication of a report to use it as a something that is specifically very up to date. But some of the issues that we mentioned remained relevant, I believe, and especially zooming out of some of the immediate fragilities. What I would like to highlight is the multi-decade trends that we found are relevant and are significant and indicate a rather troubled path for the global economy in the future. Let me state right away that our conclusion is that multilateral cooperation remains the first best option for pushing an ambition to a sustainable future. But we also found that increased cooperation among developing countries can make an important contribution, as we will see. To work into this framework, what I am doing in terms of debt sustainability assessment, I add that creating a conceptual framework to assess the financial needs and the risks is just as important. And this is something I've realized also in the various meetings that I've attended with delegates and members of the UN Assembly. So let me start by talking about inequality. Real incomes have shown low to moderate growth since the global financial crisis, with some exception, notably China. Over the past 50 years, wage growth has weakened in subsequent recoveries. And at least since 2009, labor markets have been delivering a more unequal distribution of income. Emissions, in terms of emissions, we can see here that developing countries are for sure the leading group of emitters since the early 2000s, but that's in absolute terms, not in per capita terms. And at the same time, while developing countries have made tremendous progress in reducing carbon content of their production, progress in developed countries has stalled. And the energy crisis and the geopolitical stresses have generated a strong appetite for cheap fuels, as we know, and that has interfered with climate policies. We have realized when we looked at the various reforms and policies that most of the new announced rules are set to enter into force in the far future. In contrast, what has remained in the agenda are the carbon border adjustment taxes. And those proposals, those policies are problematic for developing countries because they tighten the foreign exchange constraint for them. And in a way, pit climate change and development policies one against the other. They also have a paradoxical effect because even if they are intended to work as incentives to decarbonize, they actually induce developing countries to use domestic sources of energy as much as possible and constrain their industrialization in favor of primary activities. Government spending on goods and services has been decreasing as a share of national income. That, of course, per se shouldn't be something necessarily bad if there were a strong growth of income, but that was not the case. So the fact that this share is declining is an indicator that spending was not sufficient. And as we found out, is that that happened also during the pandemic, because even if there was an increase in transfers, there was a stall of many investment plans and investment spending during those years. What also is interesting to notice in this graph is that there's this shark fin pattern that shows that government spending relative to national income increases dramatically during crisis, and that's not just because the income doesn't grow as much, but because spending is concentrated in those crisis years, in those periods of emergency, and this is the result of specifically of a specific policy intention and economic theory that supports the idea that we should have these timely and temporary fiscal policies that act only during the emergencies and then retrench in order to recreate these fiscal buffers, let's say, during the better times, the recoveries. That, however, in our view, has been extremely problematic. For one, because it's incompatible with a development perspective that implies that there is a continuous support of the government in terms of public investment and fiscal transfers to support growth. And that is implicit in the idea that the economy does not simply oscillates around some optimal equilibrium path. That's a potential equilibrium path. Because in reality, this creates also problems in terms of fiscal sustainability, because it concentrates, it impoverishes the economy with austerity in normal times, and then concentrates the financial needs in a time of emergency when global financial markets are particularly in turmoil, so accessing international liquidity is particularly difficult and particularly expensive. So this specific approach to fiscal policy is extremely problematic for development. And of course, this point has to be brought up within a discussion of debt sustainability. So within this context of fiscal austerity, unconventional monetary policy in the past decade has been at the forefront of macroeconomic stabilization efforts. As we see in the graph on the left, there's a monetary base as a ratio of GDP in some developed and developing countries. That we used as a proxy of QE, and we can see that for sure there is a big difference between what developing countries have been able to put forward in terms of support, monetary support to their economy. But even then, even in developed countries, it is quite obvious that the QE was not capable of promoting investment, as we can see in the second graph on the right. Neither investment nor employment growth, for that matter, but if we look specifically at private investment, it has been lagging nonetheless. So this monetary policy has not been conducive to greater growth and greater development. And in particular, what has been something that we do deal with in the TDR is that there is this fundamental disconnection between credit and investment. So massive and unconventional monetary policy expansions have increased the availability of credit and the use of credit, but that did not translate into more private, higher growth of private investment, nor public investment for that matter, actually. So we get to the heart of last year and this year problem, that is the role of the dollar. What is, in our view, necessary to admit is that, and to acknowledge, is that the role of the Federal Reserve has been critical since, at least since the global financial crisis. And it did actively prevent money market freezes, at least in the core of the global financial system. It has also, even during the pandemic, allowed other central banks to reduce interest rates, and that happened massively in developing countries. And that was undoubtedly very useful. But at the same time, we must highlight some limitations of this system. For once, it is far less efficient in disciplining global finance in a context of international capital mobility. So it is able to prevent market freezes, but is not able to limit market buoyancy. And that has been evident also after the tightening began. And of course, it exposes the world to frictions between domestic needs and international liquidity needs. It's important to highlight here that the policy lever of the Federal Reserve or the central banks in general operate indirectly when it comes to prices and inflation. So ideally, the idea was to affect prices by subduing the bubble in commodity prices, not directly by suppressing or reducing prices, as well as GDP growth. So that indirectly that could prevent higher import and energy costs from spreading through to wages. But what's also evident is that the Federal Reserve does not have the monopoly of liquidity creation, and private financial institutions matter too. And what eventually matters is that the Federal Reserve remains stuck as the lender-dealer of last resort. So if a significant freeze or risk develops, they will have to intervene. So there is a key contradiction in its role. It is somehow forced to safeguard the financial stability of a system that does not fundamentally work and is not conducive of stability and growth. And as a consequence, its own the fact that it is forced to safeguard it nonetheless inevitably intensified what we can say is a separation between the financial and the real economy, and we'll discuss in more detail later also matters related to liquidity and solvency concerns. This monetary policy, in particular monetary tightening, which started with the announcements that the Federal Reserve would eventually raise interest rates, forcing many developing countries to anticipate its move, are particularly inadequate to control inflation in our view. In fact, the problem concerns especially cost push determinants of inflation, and especially the component related to energy. It's important to understand how these prices developed and are formed. And the market in these markets, market concentration and speculation are both extremely relevant, and those elements remain unchecked. And the efficiency of the dollar system actually encourages and supports these speculation and instability of prices in these markets. One example of that and one key consequence of that is that this instability of prices doesn't just create problems in terms of inflation or in terms of ability of certain countries to maintain a certain external equilibrium in current accounts and so on, but also create problems to producers, especially smaller producers, in order to be able to plan ahead and plan and invest in further extraction. That then is not necessarily something we want, of course, extraction of more fossil fuels. The problem is that at this time, the world needs fossil fuels. So if there is a way if there is the hope to actually plan for a gradual reduction of dependency on these fossil fuels, it depends on the ability to create a more stable system of price formation so that we can plan accordingly together, consumers and producers. Something we'll get to a little later, but these graphs show that often the fact that production is constrained is something that big oil countries, oil producers countries, and OPEC are accused of. But as you can see on the graph on the graph on the right, sorry, that happened in the U.S. as well. And that in the U.S. we have shale oil producers that are small oil producers that are very much entangled with Wall Street investors. And they, in fact, were the ones who, in an interview in a study by the Federal Reserve Bank of Atlanta, in a questionnaire where they were asked, "Why are you not increasing production?" They explained that it was the Wall Street investors that did not support that. So, in terms of the main conclusions of our TDR, obviously we need more cooperation between developed and developing countries. But as I said before, we also need cooperation between producers and consumers of key commodities. we need to avoid a fear of price reversal and speculative strategies in this energy sector, and clear ways to plan ahead in those sectors to support industrial transformation needed to mitigate climate change. Let me then move on to the second part of my presentation. Clearly, as we all know, in 2015, the UN launched the Sustainable Development Goals. While we have done some significant progress in terms of finding indicators for them, also explaining elements of in the institutional framework, international and national levels to support that. One element has remained key and still unresolved, significantly unresolved, which is the financial affordability of the measures needed to achieve those goals. And precisely if we want to solve that problem, we need a clear framework to assess that sustainability. That unfortunately remains most vague and contemptuous concept. Part of the reason is purely legal and political. Of course, when we talk about countries defaulting or countries who are litigating with the investors, these definitions are not just a matter of theory or a matter of planning ahead. They are a matter of actual litigations, and of course that becomes extremely sensitive, and not everything can be discussed very openly. Nonetheless, there are other problems that are more substantial and more, let's say, theoretical as well, and they have to do with the political beliefs adopted, for instance, about where freedom and equality reside, the risk posed by state and risk posed by market powers to freedom, and so on. But crucially, what I will discuss today is the underlying economic theories that make this concept so contentious. I begin so to develop a framework to assess public and external debt sustainability. I contend that many of the existing attempts, even some of the most established, have suffered from fundamental confusion between solvency and liquidity problems. And that derives from three main misunderstandings. First, growth is considered supply-driven and essentially unresponsive to demand side policies. Secondly, the interest rate is mistakenly considered real and structural rather than a conventional and monetary variable. Thirdly, and as in defying all evidence, financial markets are assumed to price risk correctly, ruling out speculation. Contrary to the first element of misunderstanding that I just mentioned, the framework I'm working on builds on a literature and scientific tradition that also developed in UNCTAD that assigns a crucial role to the state and its fiscal capacity as engines of development. And so consistently with this idea, the starting conceptual focus of my work is the sustainability of public debt, rather than the sustainability of external debt. And the matter, of course, is inevitably deeply intertwined with the dynamics of external debt. So ultimately, the attempt is to present an integrated approach. But since there is often this confusion about whether one talks specifically about public debt or specifically about external, which one is more important, I just want to clarify that the conceptual first element of importance in this analysis is public debt. And that is not because I believe that some over-indebtedness of the government would be particularly risky for a country, but rather the opposite, that the ability of the government to take on public debt is crucial and transformative. Then moving on to the second and third elements of misunderstanding, the main matter of disagreement here concerns the relation between the monetary and the financial, monetary and financial spheres of the economy on one side and the real sphere on the other. And in order to clarify this, we need to understand clearly what's the difference, how we define solvency and how we link that concept with liquidity risks. So as well known, solvency has a different meaning when it comes to countries rather than firms. For firms, the value of assets needs to be larger than the value of liabilities, but for governments, this notion cannot apply, and it's rather something that has to do with the flows over year after year of outlays and revenues. So in a, let's say, strict notion of solvency, we could say that the government should be able to cover at each time with its revenues, its outflows. Such strict notion obviously is by itself rather irrelevant, because what happens normally is that governments run some fiscal deficit without even considering a sell-off of public properties and simply borrowing. But and so let's say that what has become in the literature more relevant is a structural notion of solvency, which considers the trend over time of an indicator of indebtedness, that is the debt-to-income ratio, that crucially puts the size of the debt in relation with the size of the economy. What immediately comes obvious is that such notion requires a model of economic growth, or at least a model of economic cycle. And only with that theory in mind, one can link fiscal surpluses or deficits today with a time-dependent path to reach some predetermined target, which typically in the literature is the stability of the debt-to-income ratio, but it could be some other target, could be full employment, it could be some social environmental target, whatever one wants. And that is because obviously the sign and size of the public budget today can be deceiving, at least if one embraces a demand side macro approach. A deficit today can imply that the government is actually spending too little rather than too much, is not injecting enough liquidity into the system. And is actually reducing growth to the point that the budget cuts do not produce the desired reduction in indebtedness. On the other hand, the government instead can be running deficit because it's investing in the economy and in future growth. And you know, in general, actually, if an economy is far below full employment of resources, it's really usually a bad sign if it's running surpluses. It means that most likely it's piggybacking on some temporary favorable conditions like external drivers of growth. But that also means that all countries need to be able, without incurring huge costs, to run public and external deficits when the conditions required. Those can be cyclical conditions, and that happens to countries at all levels of development, those stages of development. It can be a more structural need to run deficits when, for a prolonged period of time, governments need to finance public investment programs in deficit, or need to progressively upgrade the economy to ultimately reduce its external dependency and vulnerability. So in reality, once we accept that there is no natural automatic market mechanism driving to development, there is the need to run fiscal deficit increases with the distance of the economy from some predetermined targets, such the Sustainable Development Goals. And with that distance, usually increase also the financial constraints. So we can say that maintaining reliable and cheap access to liquidity is a necessary condition for achieving and maintaining a structurally solvent position. And this is important because it reverses what the relation that we find in mainstream literature between solvency and liquidity. According to that literature, if a country is solvent, it's also liquid. It can also have access to liquidity easily because financial markets recognize its solvency and its reliability. Of course, we also need to acknowledge that access to credit is not a sufficient condition to create development. That's because credit can be used in whatever way, and sometimes even credit can be too much, can be disruptive, as we know, of a development process, especially in smaller economies. And that's let's say the big political problem that arises in international circles, or the relation between sovereignty and conditionality in terms of access to liquidity. And in that sense, the concept, UNCTAD concept of interdependence, the fact that one country is underdeveloped, is not developed, not by itself, but because it's part of a global economy, implies conceptually that the dilemma between sovereignty and conditionality needs to be solved thinking about the need for reciprocity in an interdependent world. What that means then, if we look at the substance of the matter, we can use what role can solvency, the concept of solvency, have in this context? We can use solvency assessments to bring back development in debt sustainability assessment, and thanks to that, we can have find, as I will explain in more detail later, different stages of development, different stages of, let's say, in which different type of degrees of external constraints, for example, are associated with different degrees of liquidity risk exposure. So if on the one hand, we have the solvency-based notion of debt sustainability are inadequate alone, so solvency itself cannot be possibly reliably forecasted, it can be the basis for simulations that provide a policy path and degrees of risk exposure based on that. So debt sustainability is best defined, and that's my conclusion that I just announced before getting into more details, as exposure to the liquidity risk at each time. Each stage of development is associated with a physiological level of such risk. So let's go back to the, let's say, the standard model of sustainability as solvency. And to do that, we go back to Domar and Pasinetti. Then, you know, the other standard reference is Blanchard, but as I explain in a second, that's quite equivalent to Pasinetti's formulation, which is just simpler to present. This is a very standard relation. At this point, I think we all know that the interest rate that applies to the stock of debt needs to be higher than the rate of growth of income at the denominator of the ratio. And the primary budget must be in surplus for indebtedness, debt to income ratio to remain sustainable. At the same time, while budget conditions may be considerably loose when interest rate is smaller than the rate of growth, but if interest rates were to rise at any time above the income growth level, the size of the debt ratio would certainly matter for its stability. I go quite quickly on these. I can't see anyone, any face. In one of you. Okay, now I can see you again. It's a bit, as we were saying before, it's a bit destabilizing when you can't see any face.
Sorry, Orsola, but I think this visualization is covering your presentation, I think.
Okay.
Can you see me now or not?
No, but okay, never mind.
I'm sorry about that.
I'll go solo.
Mysteries of MS Teams, sorry. We'll see each other later. Okay.
Okay. So this formulation can also be translated into a very similar one that takes into account external debt. And that to do that, we need to substitute the interest rate with an average effective interest rate. And here we see that there's the J is this effective interest rate. And this formulation specifically takes into account the share of domestic and foreign debt, the exchange rate, but all sorts of other things can be considered, such as maturity and so on. But this is just a simpler version that was developed by Schonerwald and Vernego. So since the public sector balance, that is the budget primary surplus or deficit, is equal to the sum of the primary balances of the private and external sector, that is the current account, the boundary relation can be rewritten, just like in Capraro and Perottini, this way. So in this formulation, there's just equivalent to the other one. In order for the public debt to remain stable, when J is greater than G, the primary current account balance must be sufficiently larger than the domestic private sector primary balance in order to compensate for debt servicing. I hope this is all quite simple, so if you have questions, please ask, but should be fine. So what is this? These formulations are just arithmetic demonstration of how debt and debt to income ratio can or cannot remain stable. But they do not tell us how the variables will move, nor how we can go from an unsustainable point, unsustainable meaning that the debt to income ratio continues to grow, to a sustainable point in the area, in the geometric area. And that is why Vagge-Prizon, for example, called this a geometry of debt sustainability. So this is it doesn't say it's a picture of how these variables, given this variable, the value of these variables, if the situation is within the sustainability area or not, but it doesn't say how it moves. And a further point, not all points in the sustainability space are economically feasible for a country. So it might be sustainable to have a very high fiscal surplus, but it might not be feasible for an economy to get there, not just because it's politically unfeasible, but it's because it's economically unfeasible, okay. This, of course, in the case of Pasinetti, was a choice, as I will explain in a second. But when it comes to neoclassical formulation, there are just equivalent formulations, and these, except that they are transformed, they are set into a dynamic context, so they use continuous variables in a forward-looking analysis, then the problem arises. There are two cases, for example, in the literature that arises from Blanchard in 1990. You have the infinite horizon or the finite horizon. First of all, the conditions in this literature are expressed in terms that the present discounted value of the ratio of primary deficit to income must be equal to the negative of the current level of debt to income. And that implies that the present value of the debt to income tends to zero in required horizon. In some cases, there's the model requires to rule out the dynamic inefficiency. That means that there's no Ponzi game condition, so the government cannot roll over debt indefinitely. But even in that case, when we are in an infinite horizon, and that happens in most theoretical exercises of debt sustainability, the targeted debt to income ratio doesn't matter anymore, and so the conditions for in the end the policy implications of the transversality conditions are rather relaxed. And Aspromorgos even shows that the transversality condition is compatible with an indefinite increase of the debt to income ratio, as long as it grows at a rate that is greater or equal than I minus G. But anyway, ultimately, it's a theoretical exercise that doesn't put any policy constraint in practice to governments. However, when these exercises are set into the real world of debt sustainability assessment exercises, for example, those run by the World Bank and the IMF, the horizon becomes finite. And then the current size of the debt to income ratio matters enormously. The targeted debt to income ratio becomes enormously important. These exercises, let me say from the start, have been extremely poor in terms of their ability to forecast, let's say, design policies that could provide a decrease of the debt to income ratio for the countries within their programs. And the difficulties certainly derive from the fact that forecasting variables that are very volatile, like exchange rates and interest rates, is complicated. But also because there are some fundamental problems, structural problems in those models. In practice, when it comes to, for example, estimating interest rates, what the IMF and the World Bank do is that after a couple of years, they forecast, they then decided that interest rate and that exchange rate remain constant over time. So ultimately, what are the problems here? So first, deciding how to time the targets is crucial in these formulations, but far from simple. Why should we say that debt to income, as a smaller debt to income ratio in 5 years from now is more important than a smaller debt to income ratio in 20 years from now, or at all? And the second issue is that probably it's debatable at all if it's possible to appropriately model this type of processes in which development implies a continuous change of variables that is not a continuous deterministic process in which the structure remains unchanged. So how do we solve this problem? How do we go from this geometry to something that has more meaning in terms of the policies we may suggest? So my solution, and this is the let's say the most preliminary part of my work, is to complement the geometry developed by Domer, Pasinetti, etc., with a more dynamic aspect related to the concept of quasi-steady state in Godley and Cripps, and then developed in a dynamic context by Perez Caldentey in more recently. In this quasi-state, we have that the stocks of private assets and debts are constant, and that is a decision based on the fact that in this quasi-state context, government expenditure and exports need to remain the main exogenous variables. And given those variables, then the flows of incomes and expenditures in each period has to be such to reconcile the change in private stocks of assets. So you have this, as I said, that this is this equation here, where you have G is the government expenditure, X are exports, tau is the propensity to import. So sorry, mu is the propensity to import, and tau is the average tax rate. If we were to move from this quasi-steady state to a full steady state, that is defined as a state in which the stock of government debt is constant and the external balance is zero, we need that the fiscal stance, which is defined as G over tau, and the foreign trade performance, with its X over mu, happen to be equal to one another. What Godley and Cripps argue is that this can happen only casually. It cannot really, unless it's specifically targeted, but normally in a contemporary economy, this doesn't normally happen. If we derive the rate of growth of this equation, we get that G is equal to the growth of exports minus the elasticity of imports to income, plus the rate of growth of public spending minus the elasticity of taxes to income. Then, if we go one step forward, I hope you're still following me. We have, if we go back to the extended Pasinetti equation, which is the equation that we got transforming the public debt sustainability solvency equation into the external debt solvency equation, we can combine the two formulations, and we can have that this becomes so if this has to be smaller or equal to G for external debt to income to remain stable or reduce, and since growth must always cannot exceed this part of the equation, then this is also the condition for external debt stability. And in a full steady state, where when the current account is in equilibrium, corresponds to this formulation. Okay. I hope that it's clear enough. This is the first time I present it. Okay, so what we have is that if, going back to what I was arguing were the principles of this of the relation between public and external debt, the goal on national level should be to reinforce the external balance dynamic in order for it to just accommodate the additional imports generated by the greater deficit spending, increase or growth in debt needed to achieve the development and environmental targets. Okay, so with that in mind, then we can use these two formulations to understand how these key variables vary depending on and characterize in a way that characterize the specific stage of development in which an economy is. Okay. So we have, of course, the current account, we have the growth of exports over the elasticity of imports, and we have J, that is an interest rate and exchange rate, and can include all sorts of financial market conditions depending on how we actually model that variable. So this formula connects short with long-term variables. Why? Because here we have the current account, and we have the rate of growth of exports, and I mean the trade performance ratio, which is a dynamic, in this case, a dynamic indicator. And once again, we can see that these can be positive for reasons that have to do with a very temporary trend in commodity prices, for example. But depending on the target when we set and on the structural elements that determine the rate of growth of exports over a certain amount of years, or the structural conditions that we want to achieve in a certain amount of years, then we can put this value in relation to the longer term value. The formula also connects the financial and the structural variables. Why? Again, because we have the variables that most define the development stage of an economy, with those that concern global demand and global financial conditions. And thanks to that, the formula provides the basis to do two things. One is analyze the real and financial elements of risk associated with the current stage of development. And based on that, the intention is to create fan charts on, that can set risk thresholds. Those risk thresholds can be also associated with policy simulations. So with policy, policies that we might start implementing in order to achieve a certain degree of development over time, and whether that can be risky, and to what extent, what are the values of certain variables that become thresholds over which the risk becomes unsustainable. And that becomes something that can be programmatic, that can bring, something forward-looking in terms of policy planning. So these are my preliminary conclusions. I'm not sure how clear the discussion was till now, but growing indebtedness is a necessary step in development process. The implication is that access to finance is crucial to determine the timing and possibility of a development process, and the reconfiguration of solvency profiles or degrees of risk, of liquidity risk to which a country is exposed. So from this point of view, liquidity is the enabler of that sustainability as well as of development. And for this reason, the definition, more accurate definition of sustainability may be that the country exposure to risk, liquidity risk at time t. The next step of this work are to consist in creating a taxonomy for those main variables, and to create fan charts of liquidity risk associated with those characteristics. Thank you.